Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Well, hi, everyone. I'm Don. That's Tom. We're talking real money on Talking Real Money. What a coincidence.
Shocking as that may seem, welcome to the middle part of June. I think I have it right? Yeah.
Is it the middle?
19th?
Yeah, I think we're into the second half
enough.
even.
I know the longest day of the year is just a few days away, and then they all start getting
Oh,
shorter.
my
So I'm
gosh.
trying not to be
Speaking
depressed.
of longest day of the year, I'm putting a roof rack. Excuse me. Got a frog. Got a giant frog jumped in my mouth, right down my throat, and ribbed.
You're looking good for that, by the way, yeah.
Anyway, I was putting the roof crossbars on the top of my car because we're getting ready to go up to Virginia tomorrow.
Yes, you are.
And it was nice and cloudy when I started this morning, and, in the 80s. And then the minute I started putting it on, the sun came out directly overhead, high noon, car's dark gray. Wow.
Little heat
It's
there for you?
Summer.
Yeah.
Oh, my gosh, it was painful. It was painful.
And you know it's summer because we might hit 75 today in Seattle. So, wow, really reaching. So,
Let's see. I'm just going to make myself feel bad because
feels
what's
like
the
in
temperature?
beautiful Celebration, Florida.
Feels like 102 degrees.
Oh, God. Yeah, I would not do well in that. You're making a good decision to move north.
It's
sir.
thick, and the air. I opened the door and it was like fog, a hot fog. It's like opening the door to your dryer when the load is halfway done. It's like, oh, jeez. All right,
Yeah.
we're here to talk money. We're here to talk about things that are important in your life and the stupid markets and things. If you have questions, we take calls all the time.
Please call us, please.
Don't beg. Don't beg.
Okay. All right.
Have some-
I'm on my knees right now. My
Hey,
hands are pressed
no,
together.
I'm telling you.
Okay.
Have a little self-respect. Get up off your knees.
I have none. You know that. I'm in the financial
Come on.
services industry.
Come on. Where's your backbone? Where's your spine?
That was removed at the same time, by the way.
Moved at birth. 855-935-TALK is our phone number. 855-935-8255. 24 hours a day, 7 days a week. But if you call us on Saturdays between noon and 2 Pacific time, which is now, or 3 to 5 Eastern time, which is now, you can talk to us live during our fantabulous radio show, which, by the way, we did not share with you as a podcast last week due to technical difficulties.
Not our technical difficulties.
No, it wasn't us. Wasn't
Okay.
us.
All right, so-
No.
Others.
The recorder broke or something.
I know what everybody
Or
wants to
somebody
know
pulled
about
the
right
plug.
now.
Everyone wants to know
almost
about
guarantee.
Friday. They want to know about
Yeah.
Friday.
Mm-hmm.
It was a bad day for
stocks.
For stocks.
Yes.
Yeah. For stocks. I mean, how bad, though? Let's put things in perspective, shall we?
Well, do you want the day or do you want the week?
Whichever you want to start with, dude.
And do you want I know you don't want the Dow Jones
I
Industrial
do not
Average.
want the dumb
So I already
Dow.
put a line through
you know,
that.
if the Dow is
Yeah.
down, here's how it works pretty much now. If the Dow is down 500, the S&P is usually down about 50. Why not just use the S&P? And it gives you the same kind of perspective, but it gives you a bigger market.
The S&P, 500 stocks.
No
The
more
Dow
Dow. We're not allowed
30.
to ever utter
All right.
Dow
Okay.
Jones
All
30
right.
industrials on this show.
Okay, so you want the
the
Standard
S&P.
& Poor's 500. Yeah.
Yes.
Lost 1.9%, just shy of 2% for the week.
Yeah, but most of that was Friday because it was 1.3 down on Friday.
It was. Yeah, it was. Here's the thing. Here's the thing about that. Two things. Actually,
why I
when
want
people start
perspective.
to say, well, yeah, here's the perspective. First of all, that's not a huge decline by any measure. Number two, the market has gone up pretty substantially here, certainly since last March, but before that. And here's the part that makes me nervous. It's when people start telling you, here's what's next and why. That's when you should really learn to ignore them, because One Think Market analyst said stocks traders are repricing now that the reflation trade is over and they're watching the Federal Reserve. It was coming, he said. This kind of sell-off was coming because the market got ahead of itself. Well, he doesn't know if the market got ahead of itself.
Wait. He knows the market got ahead of itself on Friday, according to people who buy and sell stocks day to day.
Yeah.
They thought it was a little ahead of itself. So in hindsight, he's right.
And then another analyst said the markets will be more spooked by 2022 turning to a rate hike, because that'll mean they have to taper as well. And again, that's what makes me nervous when people say, here's what's next, because no one knows what's next. Good news, by the way, great news. Lumber prices down 15% this week. So once again, Don, you can afford the plywood to put over your windows just in time for hurricane season. So that's good news.
I don't live on the coast.
Oh, okay. The other good news, good news, lean hogs down almost 12% last week. So just think how cheap that pork is going to be next time you run to the store.
Are those hogs who don't like standing on their own, but they like being over next to the fence?
Lean hogs?
They're leaning.
I mean,
they're the leaning hogs. I mean, aren't all hogs a little fatty? I mean, look at bacon. 855-935-TALK. Give us a call, 855-935-8255.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Only because it's really, really, really darned important. And it's important that you get perspective when it comes to market downturns, because market downturns are part of the price you pay for market returns. Big turns, upturns, high turns. Like, for example, if you look at the Vanguard Total Stock Index over the past year.
That's VT if you're owning it in an exchange traded fund. V is in Victor, T is in Tom.
That includes the decline we just had, 37% in a year.
That's how much it's gained.
Yeah.
More than a third.
This is so important for you to understand. You do not get to keep all of a 37% annual gain. That's part of the deal. It goes way up, and it goes down some, then it goes up, then it goes down some, then it goes up, then it goes down some. Now, I know in a perfect world, here's how you want it to work. I want to ride that 37%. I want to ride it right up to the very top. And then I want one of you guys on the radio to tell me this is the day, and you should have told me on Thursday, you dummies, to sell out. And wait until it goes way down, and then you smart people tell me to get back in so I can have another 37% gain in the year that it does it again. That's not how it works.
Yeah, I find it fascinating. So I had a great conversation with a woman that we're trying to help do some planning for retirement. Went through everything, costs, et cetera, this income, that. And then I looked at her 401k and I said, you really should put this much, 60% in stocks, 40% in bonds. And her response was, well, wait a minute. The stock market is very risky right now. Why would I want to do that?
Right now.
Yeah, right now.
Well, because
those are always the words.
Right. Now, why didn't you tell me to get in when it was down?
Exactly.
The fact of the matter is, how many of you have listened to us for more than a year? We were telling you to get in when it was down. We told you that, and I seem to remember you arguing with us a little over a year ago, back in like March
2020.
Yeah, you were saying things
down
like
30%.
Oh no! The market's
certain number of days.
You literally were telling us that the market is too risky right now. So when it was way down, it was too risky for you. And when it's way up, it's too risky for you. And that's because you're playing this stupid mind game, believing there is a way to get in at the bottom and get out at the top. And I am not the first to tell you you're delusional.
And let me tell you what I think you should do.
Please,
number one.
Please tell us.
Well, number one, you have to have a plan.
That's good.
With every dollar invested. Because even if you're 25, the plan is you're putting money in your 401k and you're growing it, right?
Every dollar. Can I play with it?
I hate people that sit around with $18 trillion in cash. That's what I'm talking about. The inefficiency of sitting around in cash. There's so much of it. Number two, that plan includes how much money you're trying to make and how much volatility you're willing to accept to make it. There isn't a return without risk. This is the part that people have a tendency to forget. As you said, they just prefer to see it go straight up. I like the
return. Hey, I like one of the R words. I just don't like the other one.
Which brings me to the third part is, you got to be able to tune everything out because the stuff comes along every day. If it's not Friday, it'll be Monday, etc. Fill in the blank. It'll be Putin got mad at Joe Biden because of their conference. There'd be a thing. There's always a thing that says this is why bad times are ahead. Mm-hmm. And you got to be able to just read it if you have to and say, I'm not going to do anything as a result of reading it.
The bad thing right now is inflation. Inflation is coming. You don't know that inflation is coming. You know that it has gone up, but you do not know what it will do. And I'm so sick of hearing people tell me that. Oh, but inflation's coming.
It has to.
It has to. It's going to. It is. Everybody says so. Everybody. Who the heck is I'm not saying it.
And by the way, once you agree to the things I just said, you don't care about all the people that are telling you this stuff because that stuff comes along and it goes away. It's noise.
But people agree to a point. You know what I'm talking about. Come on. We get it all the time. We hear from people who say, well, I'm a big believer in your philosophy, but not just right now. Just not right now.
Only when it's going up.
I'll do it later.
Really agree with you.
I'll do it later. I can't put my money in the stock market now because it's really high. I don't want that small cap value stuff because didn't that just go up a lot? Shouldn't I wait till it goes back down some and then I'll get it? I promise. Cross my heart. Scout's honor. I will get back in. No, you won't.
Though the thing is, history shows that people have a tendency to buy after something's gone up and sell after it's gone down. And you're right, Don. People believe the markets have to be timed, that you have to pay attention to what's going on in the economy so that you can sort of predict what's coming next. Those people, frankly, just end up with less money. We can show you the numbers are there that clearly point out that the people that move money around end up with less.
The problem is there are way too many anecdotes. Anecdotes. Look up the word anecdote. It's not a fact. It's not a statistic. It's not data. It's just a happen chance occurrence. And there are a lot of anecdotes where you hear about people doing really well. That doesn't mean, if they picked the right thing at the right time, that doesn't mean you will. 855-935-TALK. Call that number anytime, just like Joe did. Hi, Joe. Welcome to the show.
Hey, good afternoon.
Welcome to Talking Real Money. Yeah.
Well,
go ahead.
I am retiring at 66 in 2 years. I have a state pension that will be about $36,000. And my question is this. My wife's going to continue to work, and to meet our budget, I can either take my Social Security now, or I can take 3.5% of my IRA per year. So do you understand the question there is, should I?
Absolutely.
Yep, completely.
We hear this question a lot.
Well, what's the answer?
Well, the answer is this. It generally makes more sense.
Long, dramatic pause before he gets to the
generally
answer.
Makes more sense to wait to take Social Security because it increases each year by about 8% plus inflation. By the way, that calculation is done monthly, so you could start at some point in that period of time. Here's the challenge. On the emotional side, people say, well, wait a minute. The money's available to me. I can go get it, and I won't have to draw on my retirement accounts. I don't have to take out the 3.5%. So they generally make an emotional decision. Most Americans take Social Security way too early. They leave millions of dollars that the government gladly keeps and hopefully finances later retirements. So I will tell you that for most people, it really does make sense to wait on Social Security and begin drawing your IRA.
look at it this way. Let's just assume for a second that your IRA was going to grow at the same rate at 8% per year, and you take out the 3.5%. You're still getting 3 or 4.5% growth on your IRA and the 8% on your Social Security. So do the math. You should be money way ahead by drawing down the Social Security by drawing down the IRA just a little bit.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, welcome back to the show. I'm Don. That's Tom. We talk about money all the time. We talk about money on the weekends, though, live on Como Radio, and then we turn that into a podcast. So you can call us at 855-935-TALK, 855-935-8255. Give us a holler. And you can also send your questions in at talkingrealmoney.com. Don't put at there. You go to talkingrealmoney.com anyway. So holler at us. We'd love to answer your questions. Let's see. Let me find one here.
And while you're doing that, I'll just finish the point about Joe. Here's the thing. If you wait till at least full retirement to take Social Security, which sounds like it's a couple of years, I think, away, you have to live. You're right. Because some people do tell us, well, what if I drop dead at 71? Well, that will have been a bad decision. You will not have taken out as much as you would have. No question. So you're going to need to live a decade or a little bit longer after taking the money out. So if you have a health problem today, if you have no longevity in your family, there may be reasons to go ahead and take it. But generally, the financially correct decision is to wait on Social Security and start drawing from your individual retirement account or 401k.
There you go. Well, interesting. I have a question sent in by a person who called us and asked us a question in a previous
Didn't
podcast.
like the answer?
No. He liked the answer. He just didn't listen.
Okay.
You'll find out.
So he gets it repeat again? All right, here we go.
I called in a couple of weeks ago, and you advised me to invest what I had won in cryptocurrency. Remember that call?
Yes, I do.
Well, I didn't listen. I didn't listen soon enough.
Like a lot of other people, by the way.
And
yes, I get it.
lost another chunk before I pulled out. Now the question is, with about $125,000 remaining, and knowing I have high risk tolerance, what should my split be?
Do you know of a bridge nearby that you can just go and throw the stuff in off the bridge?
No. Here's what you should do. No more crypto ever. Take. Let's see. It's 125,000 remaining. Take 1,250. I don't know, but take 1,250 and put that in my funny money account over there. You can play with that any way, shape, manner, or form you want. You can go to Vegas. You can buy individual stocks. You can buy a Dogecoin.
You could bet on the Broncos to win the Super Bowl.
You could. You get better odds than you will betting on the Raiders.
Close though, very close.
The money, what's it for?
Yeah, I mean, this is the part people think. Well, I'm having a good time. Then, as you said, then take a little bit and go have a good time. That's okay. I was kind of curious to know how big the loss is, because maybe you could book the loss and then do that against future capital gains.
Yeah,
but that's a whole other. Yeah, no, I mean, it doesn't matter. We still would not invest your money, nor think you should invest your money in Bitcoin at all, period. Don't think it's a good idea for all the previously mentioned reasons. So that hasn't changed. I'd still get my money out.
I personally think just for me, if I am going to gamble, I want to gamble on something that will provide me with some benefit.
Yeah, like the lean hogs, because if things go bad, you're still going to get pork chops, right?
Still buying futures contracts,
Oh, okay. Well,
I would take a trip in the winter, not in the summer, to like Vegas or something, or another casino resort area. I would, if I want to gamble, I'd go play something, a table that I think I know. If I knew how to throw dice, I'd play craps. If I knew how to count cards, I'd go to 21 or blackjack or whatever.
Yeah.
Mm-hmm. Oh, that's right. I don't know how to do that. I don't know how to do it. I would be a terrible card counter. I don't keep track. I would have fun with it, but I think the rest of it needs to be invested based on your risk tolerance, which we've established is high. So based on your risk tolerance, you probably want a big chunk of maybe even you want to go as wild as buying a small cap value fund with most of it.
Oh, I think we mentioned this on a recent podcast that if you put $1 in the S&P 500, that's now about 10,000.
Right.
If you put $1 in U.S. small, pardon me, thank you, 1926. If you put $1 in, let's say U.S. small cap value, that's $93,000. 1 to 10,000 or 1 to 93,000. And you made a great point in the podcast on the last 10 years would have been a better place to be just in large cap growth kind of firms. Mm-hmm. That's done better than small, but over the long haul, it's made way more sense to be in small cap value.
And the last 6 months, small cap values ruled.
Yeah.
Which means
it's
to some
up,
of you,
year to date.
Which means to some of you, it's way too high. It's up too high, darn it. 855-935-TALK. Call us if you have a question that has something to do with money, which I assume you do because this is a money show. I don't imagine you're going to ask a political question. At least we hope not. No, Tom says.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
Hi there. Welcome back. I'm Don. Tom's over there laughing. This is
I'm
Talking
sorry.
Real Money. This is what you do, dude. You're the Ed McMahon of Talking Real Money.
That Don McDonald is one funny.
Yeah, I'm gonna host Star Search when I'm done with this gig.
What about the big checks you used to give out? What was that? Was the Reader's Digest thing or whatever?
He does
do
actually
that.
kind of remind me of you. It's the anything for a buck thing. Hey, give me a
Ouch.
job. I'll go out and do it. I do it.
I like working.
Yeah. 855-935-TALK is the phone number to call here, and Rolf did just that. Hi, Rolf. Welcome to Talking Real Money.
Hi. I'll just say this real quick. In some respects, I disagree with you on Social Security. And I disagree for the following reason. That there's an actuarially, you're going to get the same amount of money whatever age you start at. So if you start early, you're still going to get the same amount of money as someone that lives as long as you that starts at 70. So, but if you die early, you're not going to get anything.
So I'm trying to make sure I'm understanding what you're saying, because my point is if you take it at full retirement age, and yes, you do have to live about a decade, versus taking it at 62 and living a decade, I don't believe the numbers are the same.
No, they're not.
Well, if you take it at 62 and you live 15 years instead of starting at 67 and living
right.
10
If you
years,
die earlier,
it's about the
yes.
same.
If you die earlier, you're better off taking it early. But if
problem
you
is most
live
people don't.
into your 80s, the numbers support, the actual math supports taking it later.
And on top of that, if you're married and you're the larger earner whose benefit would be likely to be inherited, remember, because when you pass away, your significant other can either keep theirs or take yours, then it really plays out even more substantially.
And here's the reality of it. If you wait until there's a break-even point on each one of these steps. For example, if you wait to take it until you're 70, you have to live past 80 and a half.
Yeah, it's about right.
To make more money. So if you live past 80 and a half, which a lot of people do, if you've made it to 70, your odds of living to 80 plus are
one
pretty
of
good.
the two of you.
One of the two of you. So you're playing the odds. You are. Everything in life is a gamble. And if you don't have longevity in your family, take it early. Sure.
And if you need the money. I mean, a lot
Or
of
if you
people
need the
don't
money.
have a job and they got to have income. Sure. It just, as I say, for people that can make the decision one way or the other, generally the better decision is to wait.
Generally. And again, nothing is an absolute in life. We are just playing the odds, and the odds are very, very good. If you make it to 65, as a matter of fact, that the majority of people who make it to 65 are going to make it to 80 plus. So it's a gamble. Everything's a gamble. 855-935-TALK is our phone number. 855-935-8255. I mean, bear in mind, at 62, if you take it early, you get 30% less approximately than you get at full retirement age. 30 something. Yeah.
Yeah.
If you take it at 70, you get about 25% more than at full retirement age.
Yeah, you're waiting those additional 3 years. Yeah, exactly. So, again, that's the other thing I like to point out to people. Once you take the benefit,
it's locked.
That's it. I mean, there's small inflation, a cost of living increase that you get that's been minuscule the last decade. Now they're saying for next year it might be as high as 4%, which would be terrific. But again, you get the same basic benefit for what could be a very long period of time, 20, 30 years. And imagine, I think if inflation runs at 3%, prices would double in about 24, 25 years. So your earning power is less than half.
Again, if you're in ill health, you're in your 60s and you're in ill health, the odds are not great of you making it into your 80s, then please take it, enjoy it while you're alive. But if you're going to try really, really hard to live a long time, and many of us are doing that a lot longer than we ever did. Remember, when the retirement started, when Social Security started,
1934, 35.
The average age of death in the United States was 65.
Yeah,
that's when you died.
What you got. You weren't expected to be drawing from the government for 30 years the way some people do today. Yes, that is correct. So, Rolf, you make a good point. And the government has spent considerable time on this because it is actuarial tables that they've come up with. But in that case, for Joe, I don't think there's any question that he should take it from the IRA and wait on Social Security.
855-935-TALK, 855-935-8255. Give us a call. We'll try to help you muddle through the massively confusing world of money.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Money makes the world spin on its axis. Or go round, some might say. 855-935-TALK is the number to call here. 855-935.
Real deep.
I'm telling you, I'm a deep person. As is Dan, who's up next. Dan, welcome to Talking Real Money.
Hey, Dan.
Gentlemen, good afternoon. Glorious.
Oh, he's in fine feather, as they say. Fine feather.
Yeah. Go ahead,
yes,
Dan.
Indeed.
What do you got?
Two things. Number one, I was number 316 on your YouTube broadcast. Happy to see
people are taking numbers now.
You're number 316? Wow, thank you. That's good.
Yeah. Having seen the two of you operate with and, so to speak, against each other in live sessions, it's refreshing to be able to continue to see that even in these
we have to be
days.
We have to be 3,000 miles apart, or it would get ugly.
I'd prefer 3,500.
And I meant to say you were in fine fettle. I don't know where I got the word fetter. I was fettering you instead of fettling you.
I think we should leave it at that.
Yeah. Well, thanks for watching, though. You and like 12 other people. So.
We're getting a lot of views on that. We're almost up to double digits here, I think, on a couple of them. So, yeah.
Yeah. So, a question for you today.
Yes.
2 weeks ago, you did a wonderful session on preparing a spouse in the case of the early passing of their partner. And one of the aspects that you didn't cover that is on my mind as I think about preparing for the future is if there's a notable IRA or funds there that are generating income when one spouse passes suddenly after the end of that tax year, they're a single earner and the tax bracket shift, the Medicare numbers change. Is there anything that can be done ahead of time to try and prepare for that day and reduce the impact on that remaining spouse.
Wow.
Yeah, I'm sitting here.
I'd have to think of it.
I have never had that question asked, but it makes perfect sense because you do end up
It's going to happen.
filing
Yeah.
singly in the next tax year.
I don't know what that would be.
I can't think of a thing. I am absolutely stumped. Neither of us are accountants, though, but I just don't think there could be anything. When you think about it, and I hate to say this, but the only way, the best you could protect your spouse by saying, all right, here's the deal. When I die, go marry him. Just to get a tax deal.
I might do that to her just to spite her after I'm gone.
I got to tell you,
I've got
the
a couple
tax
people I
tax
could
laws,
set her up with.
this married filing jointly and married filing separately and all these things.
Yeah.
And single file. This is all social manipulation on the part of the government.
Madness.
It is madness. Yeah. It's just crazy. I got to tell you, I would stay married even if it wasn't good for me, just for the tax break now. It's just, I don't think there's a thing you can do. But if somebody has
Dan,
an idea,
do you have something
call.
in mind? Do you have an idea? Dan, somebody thinks a lot about these things. Do you have an idea?
Well, the only thing I can think of is to try and get as much money out of the IRA early, even though it may be a greater tax hit in a dual filer tax bracket than hopefully provide an advantage versus a single filer.
I guess that may be a reason to push the Roth conversion a little harder. I guess particularly if you're terminal, you think there's a chance that you got a year or less to live, you might want to do some quick Roth conversions or a couple years. That's the only thing.
But even then, you got to worry about the brackets because you get bracket creep and it just gets kind of messy. Yeah, no, I think you stumped the near stars, Dan. So
near
well done.
stars.
Well,
wow.
There's a star right over there. You think
a lot of us.
I said near stars, not stars.
I don't even think we're nearly stars.
All right. Thank you for the call, Dan, and thank you for always Dan's always thinking about this stuff, so he calls.
I'm glad somebody's
frequently.
thinking about it.
Keep us on our toes.
Because I'm not.
Yeah, a little bit of this is there's a lot of planning you can do to make sure things are going to be okay after you're gone. Some things I think are just going to be, it's going to happen the way it happens, but it's hard to fix every problem what your spouse is going to look like after you leave.
That's absolutely true. It is really, really hard to take care of every eventuality. I mean, you could spend a fortune, and this is something we talk about a lot. You could spend a fortune on insurance and lawyers and all of this stuff over the course of years, and still not solve all of the potential problems because you can't anticipate everything.
Yeah, that's one thing. And I think the other, frankly, is simplicity. We've talked about this on the show a lot, to make things simple, especially if your spouse is sort of the disinterested person in all of this. Know who the spouse should call and share the plan. Here's how things are sort of set up and why they're set up this way. But you start getting past that, Don, where you got insurance policies to pay this. And I think it generally ends up being expensive and confusing to people. I'd put it that way.
All right, I have another question for you.
Oh, please.
This one was sent in at
Since I did so well with the last one.
Well, this one's one I think you can answer. Pretty sure.
Oh, all right.
About 403Bs. I found your show a few months ago and always look forward to the next podcast episode. So they listen to the podcast on their favorite podcast.
Do they watch it on YouTube?
I don't know. They didn't say.
Okay.
I am 50 years old and plan to work for 15 more years. Listen to the question.
Yes, go ahead.
I postponed my 403B contributions for 3 years to pay off debt. I currently have $170,000 in the account across 3 accounts with fees of 0.29, 0.75, and 0.65. My organization.
Wait, there's 3 different 403Bs? Is that what
3 accounts, yes. So I don't know if it's 3 funds. He's not saying. I think it's funds. I think it's 3 funds. Because he goes on to say, my organization has 3 providers with similar or worse fees. God, you gotta love school districts and hospitals for their incredible job going out and finding the best sources for the funds. You guys you do what's best for your golf buddy. It's just irks me. Anyway, my question is, what should I do about the 403B when running the numbers? 20 to 25% of my final investment would be lost to fees. I have an additional 500 to 1,000.
20
No, that's
to 20
not right.
to 5. That
not
can't
right.
be right.
Yeah, I think he's compounding it out. And my wife and
No,
I.
because if you're paying less than 1, that's still reasonable.
Exactly. It's not horrible. Yeah. My wife and I fully fund a recently opened IRA through regular monthly contributions and will receive a nice pension at retirement. I appreciate your ideas how to invest the additional money. So the additional 500 to 1,000, that's really what he's talking about.
Yeah. Okay. So then you go back there and you're going to, in any plan selection, the first thing you're going to do is try to see what asset classes are available, right? Large cap, small cap, international, all that sort of thing. That's one. Then you're going to put a line, hopefully, through all the expensive funds that represent those asset classes. Most even 403Bs generally are going to have some sort of index mutual funds. We prefer to see you use those for the lower cost.
Doesn't sound like this one, Will.
Yeah.
Not at those fees.
No, one was 2.9 though, you said, or something, right?
0.29, but he said that's the very best of what is offered.
So, but then in that case, then you're going to probably want to go to the default target date fund, which is simply going to be lower cost. You don't have to worry about it. It's managed. And you don't muck around with all these high fees and trying to pick it all out.
One of the little bits of advice that I've given to people in the past, particularly those who work for school districts, because you can get a little political clout, particularly if you get parents involved, is to get other teachers and parents, and if you have a union, the union involved, in getting you some better choices, petitioning them for Fidelity or Vanguard or Schwab or someone with a lot of good index products. And get some other teachers with you and some parents to contact the school board and try to get them to give you a better plan.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
While we believe we can answer most of your questions on the show, there are sometimes questions that get very involved. I got a couple that were sent in. They're like pages long with all the funds that people have. And when you have those, you might really want to spend some time talking to somebody who isn't going to try and sell you something.
And here's the thing, if you talk to one of our advisors at Vestory, we will look at your portfolio to tell you how diversified you are, how much you're paying in fees, and how much risk you're taking, because many of you do not know those things, and you have to in your portfolio.
And the cool part is that our advisors will help you. They're fiduciaries for free. We don't sell products. There's no obligation, no cost at all. And the best part of all is that there is absolutely no high-pressure sales pitch. Just go to Vestory.com. That's Vestory.com. And you scroll down, you set up the appointment. Actually, go ahead and set up an appointment. Somebody will call you. They'll verify that. We'll set it up with somebody, and we'll make sure you're taken care of. That's Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?
The preceding program was paid for.